Go. Hello, everybody. Welcome to, well, this is going to be called The Closing Beat today. How you doing? All is good out there? Sorry, I'm just really excited. Charles, my man, made my day. Charles sends in a General Motors stock certificate. Look at that bad boy right there. I love these stock certificates. I got a bunch of them, but I don't have a General Motors one. And as we met up with Charles a couple weeks ago, and he mailed that to me and made my day, man. That is super, super cool. It's got that old smell to it, too. You know what I'm talking about. I appreciate that, Charles. We are financial advisors here at Jazz Wealth. Hope you're having a good day. Hope you'll check us out at jazzwealth.com. While other advisors are playing checkers, we are playing chess. My example today, should you eliminate a big chunk of your Roth, take the withdrawal, pay off your credit card debts? What's the win-win-win in that case? We're going to go over that tonight on Jazz After Dark. If you'd like to take a look at that, right? That'll be up later? Yeah. That'll be up later. Should you take from your Roth IRA a large sum of money? This is based on what a client actually asked me. I want to show you how we found a win-win-win for doing that when you wouldn't think there'd be a win there. Strategy. Love the strategy there. Also, Wine and Wealth last week was an actual throwback Wine and Wealth. We had some great wine that Jason sent over, or brought by to us, actually. And we talked about wealth in a really more detailed way to get you thinking about growing your dough. Not bad day for trying to grow your dough in the stock market. Not horrible, you know, it's what it is. Kind of sucks because, well, we'll get to that. Let me start with this. You got 1/3 of the S&P reporting this week. The big names, the big tech names, that's really going to be your focus. That'll steal the headlines anyways. Microsoft's going to report, Alphabet, you've probably seen the list. I'm not going to go through all of them there. You get it. Amazon, the big names there. I do want to point out they also have Ford, General Motors. Those are going to be interesting ones. Southwest Airlines, IBM, Visa, I think will be interesting. Verizon, Chipotle, UPS, which is always a great barometer for the overall health of the economy. And ExxonMobil, lots of movement going on over in the oil space right now while everybody's looking over here at the war, at least lawmakers anyways. They're saying, hey, this is our chance. Let's get some stuff there. Get some stuff done. I do want to point out the theme so far for this earnings season, cash spending. Haven't seen this in a while. We talked about this a while back, but investors are rewarding companies based on how they spend their cash. Should not be a surprise to a lot of you longtime viewers out there, but we're seeing S&P cash spending, CapEx, R&D, dividends, and just returning cash to shareholders in the form of buybacks or doing M&As, which we've seen a little bit of. That is all up by 12%. Okay. What do I do with that, Dustin? How do I make sense of that? Companies that have decided to use up some of their cash to expand, build a new plant, right? Hire more people, whatever it may be. They're not getting rewarded. Companies that have increased their dividend or have laid out a path to increase their dividend, companies that are buying back stock, they're getting rewarded right now. Why is that? If you want to look for the best performing stocks that are cash to spend, it's the companies that are paying higher dividends or that are starting to pay higher dividends, and they're returning cash to shareholders in the form of, like, you know, share buybacks and one-time dividends and things like that. Those are your best performers. Why? Remember the cheat sheet, right? It's a real simple thing here. They know this. You probably know this as well. That's going to kill me that that's not perfect. Let's take a look. Based on the economic cycle, you've seen this before. I've shared this with you. Based on the economic cycle, investors like to see companies do different things. Right now, we are basically here. I'd argue maybe just a touch lower than that. We've obviously peaked out. The economy has shown that it's peaked out. How much it's going to pull back or how weak it's going to get remains to be seen. But we are here. When we experience a slowdown, remember the stages of an economic cycle from Economics 101 in college or high school or whatever. When we experience a slowdown, we want to investors reward companies that have high balance sheet strength. And it's just because we attach an index to it. That's why I say high. Returning cash to shareholders. Yes, that's what we want to see. This is like the cheat sheet here. Investing for growth. No, we don't want to see that. right? We want to see investing for growth as we rebound, as we expand, and things are good, right? This part of the economic cycle there. So really, really simple. CEOs just go and they look at that cheat sheet there and they go, do we want a higher stock price or do we want to expand our business? You can't have both. It just will not happen. A great example would be what happened today. Look at, here's a great example. There you go. Chevron. Hess, right? If you saw the news, Chevron buying out Hess there. Oh, we're going to spend our money on M&A. Right? To maybe eventually expand the company. And look, we're going to be a bigger company by buying Hess now. No, you don't get rewarded for that. I'm sorry. You must not have looked at the cheat sheet here. See, we are here. We don't want to see you do that right now. Therefore, the stock is not higher, right? So when in doubt, refer to the cheat sheet. You tell like the CEOs to do that. That's what's going on there. Also, this week we have the advanced GDP number coming out. Remember, this is supposed to be a big number. They said, oh, we think there's going to be 3.6% growth. Well, that's a lot. It was just like 2.1 last quarter. Remember when we talked about that? They're shooting for 3.6. We'll get that number out there. We'll see. How are we getting any stronger out there? Where is that? What's happening? What am I missing? Furniture, sporting goods. We saw retail sales numbers. Dining out, going out to a bar, going out to restaurants. You know, we now officially... It's been like this for a little bit. We officially spend more eating out than we do buying food at the grocery store to come to, you know, cook or do whatever you do with the food when you get home there. So anyways, we'll get those numbers that come out there and so be it. We'll see what happens along with a whole bunch of earnings. That's the gist of what I was trying to say. The S&P lost 1.3% last Friday alone, right? So here's Friday. Using the S&P, we break below the 200-day moving average or we close below the 200-day moving average. Not an official break, but you do see, when's the last time that happened? March, right? So a little bit of new excitement there if you like pullbacks or if you've been waiting on a pullback or have just bought somewhere in here. You're like, all right, that's good. Fun fact. Oh, fun fact. Okay, check this out. All right, today's Monday, okay? The last 15 Mondays have been positive. You look all the way back. The last 15 Mondays have been positive there. Today breaks that streak. We're not going to get 16. We finished negative on the day, right? I look back to 1945, as far back as I can go with this type of data, the intraday closing data, 1945. I couldn't find any. There's no other time where the S&P had 15 Mondays in a row that were higher. It's just a fun fact. It's not like that relevant, right? 2005 was the last time we had hit a double-digit number of 11, right? So 11 was the previous closest one, I should say there. And one more fun fact, if you take just those 15 Mondays out, the market, if you take out all Mondays, right? Take the Mondays out year to date. The stock market's actually down just about 1% for the year. So Mondays have been pretty important. Today, obviously, a changing of the guard, right? A little bit of a change there, something to pay attention to. Just a fun fact, not just, you know what I mean? I'm not saying anything, just, you know, we notice these things. The Dow. So not very interesting, anyways, as far as the Dow goes. It's down 4 of the last 5 weeks. I don't know what to say. It's down, right? We're back down towards these lows here. It's just not a very interesting index this year. I'll tell you what is. The NASDAQ lost 3.2% last week, down 4.3% in 4 days. So we're happy to see a little bit of a rally here, averaging more than 1% a day declines anyways. So far, so good. Now, remember, the NASDAQ has a lot more strength to work from. So a bigger pullback, if it happened, would not be odd. It would be very much within the normal volatility of the NASDAQ. So far, it hasn't done that, which is really good. If you're a bull, you're like, okay, I got a lot of gain this year if I invested in the NASDAQ. I'm okay with a little pullback. You're not even getting a meaningful pullback here. So pretty cool if you're looking at that one. We'll see. Like I said, the earnings, Microsoft, Meta, Alphabet, Amazon, and more to report. So that's likely to have a little something, they're likely to have something to say about that. Okay, moving on over to bonds. Yeah, you probably saw a lot of this over the weekend. I'll try to attach something a little more unique to this for you so it's not me just repeating stuff you could have found elsewhere. We went above, this morning, we went above 5% on the 10-year, or we hit 5%, and then it started pulling back there. I'll tell you, the last time that we were above 5%, on the 10-year, the housing market crashed. You know what I mean? Full on, just crashed, just shut everything down. It wasn't good, right? Financials, horrible and all that stuff. Just to give you a little bit of a feel for when was the last time this happened? This just doesn't seem too real there. Also, real estate, the average mortgage rate, that was the headline this weekend, 8%. We talked about it on Thursday. 8% mortgage rates. Oh my God, what are we going to do? Let's look at it a little bit differently. Is it good or is it bad? I tend to think this is a little bit bad, but hang with me. We've done this in the past for clients. We take the home affordability by the number of hours you have to work. Because if I tell you that it's 8%, you're like, I don't know, that sounds high. I don't know. The median average or the median home price. Okay, it's high. I don't know. Do you have the money or not? Are you going to save it or whatever? But let's talk about making your monthly mortgage payment. If you put 20% down, you have to work, and this is just a normal working class person, right? You've got to work 73.4 hours. If you had 20% down right now and you bought a house, 73.4 hours to make your mortgage payment. All right, I don't know. Is that high? Let's see what happens. If you put 5% down, you got to work 87.1 hours. The average work week is not 40 hours anymore. Now, you probably are working 40 hours, but across the United States, it's not 40 hours. It should be more than that. Anyways, so we compare that to history. We go, okay, well, you put 20% down, 73.4 hours. Let's just move our way over here to the left. It's a little bit higher than 2005, 6. We can go back over in here. You got to go back into the 90s, right, to really find a number that's convincingly higher than this prior high. It pretty much, a lot of you, it's going to be, you've never seen this in your lifetime if you were to buy another house right now. So the reason I think that's bad is how do we have economic growth when that happens? By the way, the number of repairs, they track that. Repairs, additions to your house, furniture purchases that you would use to your house, whether you do large-scale things like add a pool or build a shed or whatever, all of that down. Okay, so think about what that takes. It takes lumber, it takes parts, supplies, tools, all that stuff. And if we're not buying that because we don't need to do anything there, and it costs so much to own a house, how does the economy grow? You know what I mean? Just from a really basic standpoint. How do we not slow down at this point? So don't act shocked if you start seeing data that's like, yeah, okay, the economy's slowing down a little bit. It's okay. You can just see it coming. And it's not doom and gloom. It's not chaos or anything. It's just, we're just slowing down. Who wants to do that? I don't want to work 73 hours, put 20% down on a house that maybe I didn't even want in the first place and have to work that much. I wait. I put more down, save my money, do something else. That's kind of the mindset going on. All right, Philip Morris out there, they do the thing with the heated up tobacco there. They have applied to do more of a commercial standpoint for that. I think it'll pass too, because that's different than the vaping, remember? It's that heated tobacco system. Okay, Disney, they're going to sell off part of their, I think all of their India operations and everything that goes along with it. I believe that was the case. That came out sort of early this morning. And that's it. There was no other real news to cover there. I already talked about the Chevron thing. So now they're going to buy Hess, which is public company there. They're going to buy them. Comes out to $171 a share. Chevron spending their money on expanding, not on returning cash to shareholders, at least at this point. So not a real win for anything there. Also, you got a lot of earnings tomorrow. If you're interested, the worst one is Snap. So Snap is down 6 of the last 8 earnings reports. Maybe this time it's different. I don't know. Raytheon also down 6 of the last 8. However, there's a lot going on there right now. And the best one, I believe, is Coke for tomorrow. Coke up 6 of the last 8 earnings reports there. Obviously, it's pretty stable in terms of earnings. You usually don't have wild, $5 moves in one direction. That's not Coke. All right, this evening, if you want to see a strategy wrapped around taking money out of your Roth IRA, I guarantee you no other advisor is going to say, yeah, take money out of your account, your Roth, and just go pay it off. But does it make sense? And actually, I got a little off track here because when I was making this, I started thinking of other things. And so it's a really, really cool strategy sort of session. If you're interested, grab a drink, come hang out with me tonight. I'll take your questions here if you have any. And if I happen to know the answer, No fantasy football, please, because I don't want to jinx it. It's going well. I'm pretty sure after tonight I'm going to be 4-3. Well, and it beats the devil out of a lot of the other people too. There's only like I think I'd be back in second place. Excuse me?
Sounds like you need to start a fantasy football course. You know what you're doing, sign up for your course.
No. I just follow Tay-Tay's Twitter. That's all. Do you want to do the Guess the Dow winner, right?
Yeah. We got your Guess the Dow winner from last week was Eric S. Eric S. was your winner with a guess of 33,125. He's not a client, so he's going to get $100 just for playing our game. It's the craziest thing we do. You can also play at jazzwealth.com/guess the Dow.
So anyone can play and get the $100?
I think, yeah, just about anybody. Yeah, maybe, even inside this office, I guess, yeah. Anybody.
Hot damn.
That's crazy.
That is something. Other guy says Japan's debt to GDP, 263%. We're getting there. Give us some time, man. 2025, we'll be at 123%. We'll catch them. Don't worry about it. Let me see. My little guy here, I'm going to refresh this page because it is not showing me the comments. If you have any, I'm happy to answer. Otherwise, I'll get out of here. I'll go on, do what I got to do. Mr. Andrews, I've given up at this point. No way I'm paying 50% more net monthly salary for a mortgage. Well, yeah, and I'm not like, I guess, taking a stance. I don't know what's going to happen, right? That's not my specialty. I'm just saying I talk to people all day. Emails come all day, phone calls come all day, and everybody's doing the same thing. It's usually a pretty good measure of what the masses are thinking. We're all just kind of cool to be like, even me, I'm not moving. I'll just sit here. Yeah, okay, the house went up a lot in value. I have no need to go anywhere. What am I doing? So think about that. It's crazy. We have this slowdown clearly happening there. That bleeds over into everything else. So I'm just not buying this, hey, we're going to grow our way out of this. With what? Manufacturing? MD, with bank stocks dropping, is a good time to pick up different banks now. I've gotten that question a lot. A lot of people like the fact that generally the large banks, their financials weren't good, or at least the response to their earnings were not all that good, which has caused the large cap financials as a whole to fall. And then if you kind of look around at some of the other names just individually, you're like, okay, well, it seems like a little bit of a discount here in the short term, not for all of them, but of course you get what I'm saying there, Bank of America as well. What I don't like is the timing of it, right? You have a market getting weaker, and sure, likely will give you some sort of attempt at a bounce. It's done that every single time, right? So in a downtrend, we do see bounces that make you feel like, oh, this is it. We're also at a really obvious technical support level, so I'm kind of in like a patient mode here, not needing to be the one that does that. That ought to give you a little bit of time, too, to see if Israel's really going to do a ground invasion there, because that'll cause a little volatility here for sure, short term. Yeah. Higher rates, market access benefits, they benefit from volatility. So the rate, it's kind of like, have you ever looked up, well, you could look up any of them, but for example, Interactive Brokers, that's their deal. And so if the market is more volatile and there's more to buy and sell and things are going up and going down real quick, these guys higher revenue. You wouldn't think that because there's not necessarily commissions. They still have commissions, I guess. But market access is very similar about the bond market. So that volatility in the bond market, that adjustments in the bond market, the banks needing to liquidate, which they don't all use them, I guess, but the offsetting parties do. So yes, short answer is yes, should benefit them. We should see higher return from their trading volumes when they report earnings. Yeah. And that's what they mean, by the way. When you look at when Goldman Sachs or somebody says trading resulted in X number of dollars in profit, that's not just dudes sitting around picking the best stock of the day, right? That's definitely not that. People like to think that. What's the difference between Treasury and, I think that got cut off. Happy to help if you know the full question. So if you don't think there's an easy way out of the slowing economy, does that mean you've given up on the soft landing? No, I'm definitely not a hard landing person. I'm just saying How are they just telling us everything's great? We're growing. This is looking good. No, we can see. We're out there. We see the more available places for lease. You see, of course, people shopping a little bit less, at least apparently there. You see the car lots filled up there. You see people not moving as much. You see open house signs. How many years has it been since you've seen an open house sign where the realtors are like waving the cookie smell out down the street? Come on in, you know? So little things like that. I'm like, all right, it's okay. We could have a slowdown. We're not going to have this all-out collapse or anything like that, but that's what I mean by that. Yeah, I know. Charles Schwab's another one. Yeah, it's a little bit different because they got their hands in a few other things there. But for example, if the stock market was more volatile, that'd be good for them. That goes back to my old days. I used to work at a brokerage firm, and when the market was more volatile, everybody was happy because they were going to make more money. You're buying and selling and switching and margins and all that stuff. So it was a good thing for them. Slow, boring, uptrending markets, usually that come after a correction or something like that. Well, it's not so exciting. People are happy. They're not fearful. They're sitting back and waiting. So things like that are do translate into stocks themselves. If the question is something about Schwab right now, very hard to get excited about it, right? So I'm not going to be the guy that's like, yeah, that's right there. That's the bottom. I don't see a reason to do that, man. Yep. All right. Good. Oh, thought I pressed the wrong button. Okay, so we did that. We are good. We've got a week that's going to go like this in terms of things to talk about. So enjoy. Get your rest there. If you want to see a strategy revolving around maybe borrowing from your retirement, your Roth IRA, to pay off credit cards and get yourself back on track without damaging retirement, I'm going to dive through that using Nest Egg here tonight. Come join me for that. And the rest of you, I will wish you have a good evening. That's it. Goodbye.